Hi everyone, this is Josh Nelson, Keystone Financial Services. Glad you are here today. Whether you're watching a recording or you're here live, we actually find that most of our people watch the recording, which is great too, because you can just do it on your own time. But certainly we appreciate you being here today. We're going to talk about charitable giving. We're going to give people about 3 more minutes to sign in. We know that a lot of people are coming in over the lunch hour or from another meeting, so we want to wait till 12:30 Mountain Time, and we'll get started here in just a moment. While we are waiting, though, definitely look for a couple of tools inside the GoToWebinar toolbar. One of those is the questions box. Feel free to ask questions along the way. We'll definitely get to those either during the presentation, we'll see how it goes, and we try to be interactive with that, or at the end if we've got some questions that we've got at the end. So it's a topic that a lot of people are thinking about right now. Of course, this is the giving season, right? It's Christmas is about a week away right now, or even less than, I think. So definitely a time to be thinking about giving, and not only to individuals, but also to charities. So we're going to talk about that today as far as how to effectively give to charities and to be able to leave your legacy. So with that, again, questions feature. Also look for the chat feature. That's a way you can communicate with us along the way. For distraction purposes, we turn off everybody's microphones during the presentation. That way everybody can kind of do their thing and also be able to interact with us along the way. So we'll give people another minute or two here and we will get started. Hopefully everybody can hear me okay. If anybody can't hear me okay, if we've got volume or video issues, definitely let us know either in the chat feature or the questions feature. We'll get started in just a second. I'm a little bit congested, by the way, so it's not the audio, it's me. All right, we'll get started here right at 12:30 Mountain Time. Just use the opportunity to locate those GoToWebinar features. And for those of you who are tuning in live, big benefit of that, of course, is that you get to ask questions live. But for those of you who are dialing in late and you've got questions, certainly feel free to reach out to us directly. You can just go to our website, keystonefinancial.com is the easiest place. You can just email one of us directly. Jeremy and I are here today. I'm going to be on camera and on the audio, and Jeremy is going to be answering questions outside of that. So I see 12:30 on my clock, 12:30 Mountain Time, so we will get started. Again, our topic today is charitable giving. So really building your impact. And of course, there's a lot of different ways you can do that. You can do that with your time, of course, and a lot of our clients do that. Certainly recently we are very, very thankful that our clients participated again with us this year in the Toys for Tots toy collection. In fact, I think the Marines are coming tomorrow to pick up toys, and they're going to distribute those out really in the next few days to kids who could use a smile on their face. Certainly a lot that we have to be grateful for, and certainly want to be able to share that as we can throughout the year. But that's one that we always have made a tradition at Christmas time of participating with Toys for Tots. So we're going to be talking about charitable giving today. And last month we talked about gifting to individuals. How do we leave a legacy either at the end when we pass away or during our lives as far as gifting strategies? How do we do that? Now we're talking about charitable. And again, of course, this is the time of year we're thinking about gifting, right? We're thinking about helping others. We're thinking about buying gifts, for our family members and so forth. And I think that you probably would agree with me, those of you who have a few years, beyond your teen years at least, is that you start to really enjoy giving more than receiving. It's actually a lot more fun to be able to shop for people and watch them open their gifts than it is to actually get the gifts. And so that's one thing that I've really enjoyed over the years as my kids have gotten older, certainly, and enjoying Christmas that way, but also really being able to give through my time or through treasure, right? For those of us who have the financial means to be able to help out where we can, certainly charitable giving is a way to do that. So we're going to talk about a few different things today. I'm going to jump off the camera here in just a moment, but to kind of set the stage, we're really going to talk about not only current giving, but also thinking about legacy giving and the best way to do that over the years, not just current stuff. Because really, giving current stuff is fairly straightforward, right? Giving securities or giving cash or even giving property like a vehicle, it's not that complicated. We're going to talk about how do we give stuff that would actually benefit charities over the years, possibly, and then also talking about donor-advised funds, especially for those of you who have highly appreciated assets. That can be a very, very effective way of not only being able to alleviate some taxes, but really benefit a lot of different organizations that you may care about. So with that, my name is Josh Nelson. I'm a certified financial planner. There's a lot of different job titles people like me use: financial advisor, investment advisor, financial planner, certified financial planner. But the CFP, that's the gold standard when it comes to the financial planning industry for somebody who would be managing your wealth or giving you advice on your wealth. That really is the gold standard. So very proud of that fact that I'm a CFP. Jeremy's working on his CFP right now as well. And so you've got two very, very qualified advisors here in the office for your boots on the ground. Also the founder and CEO of Keystone. So I started the company about 9 years ago right now, and time sure does fly. This is my 20th year as a financial advisor. And it's been so fun over the years, not only to be able to do what I do because it's fun work, but also because of the impact that I get to have on people's lives. That Jeremy and I get to sit down with folks, and we learn things and learn about people's hopes and dreams and the heartaches, right? The tough stuff that happens in life as well. It's just so neat to be able to have the impact that we do, and I'm very very proud of the fact that we're able to build that up as an independent firm here in Northern Colorado. So with that, I'm going to pop off of the camera here for now, and then we'll start going through the actual slides. But I've not gone away, and again, Jeremy is with me as well here to answer questions on the other screen. So with that in mind, let's get started. As far as charitable giving, we'll talk about a couple of different items here to kind of set the stage. One of those is just understanding the landscape of things. I think this can apply to any area of financial planning, that it's so important to understand the rules of the game, understand what the choices are in how we give charitably. Really could end up not only benefiting ourselves, because of course we want to help from a tax standpoint. People usually don't give to just get a tax advantage, but certainly we want to take advantage of the rules, and anytime that we can hide money from the government legally, at least, we want to do that. And certainly we want to be able to benefit some great organizations that we care about, whether it be a church or a charity, some kind of a nonprofit organization that we might care about. Now the landscape on this is changing year by year, right? Because the tax rules change. And so some vehicles may make more sense than others. So depending on when you're listening to this, this is at the end of 2019. And one of the things that passed this week is the Secure Act. At least it passed through the House, and it could have some really far-reaching changes, actually, as far as how people plan their retirement. If they've got things like 401ks and IRAs, that's a whole other webinar, by the way, that we'll be giving in 2020 once we digest all of this and it gets signed into law. So keep in mind that all the stuff we're talking about is just the rules as of right now, and things change all the time. So really, it's just more an awareness of how do things work today. So we're going to talk about really how to build a strategy around this. And I say that just because in a lot of cases, people don't really think ahead a whole lot. They might give charitably through a payroll deduction, or they might just kind of give sporadically, and they might not put a lot of thought into not just the dollar amounts, but what they're giving, what kind of property they're giving, and what are the tax ramifications of those things. So we're going to talk about the charitable giving vehicles and kind of the landscape of things today. Also talk about resources, really, so you can learn more about this stuff. We'll give you some links later and some things to think about as far as how you might set up your charitable giving. And then also really just some of my own insights. I'll give you some of my observations from working with clients for 20 years, really what works well and what doesn't work so well. We'll talk about that as we go, and certainly throw out some questions and chat along the way. Maybe situations that you run across that you want me to bring up, or maybe some questions that you've got as well. So we'll talk about common questions here. Number one, do you have a favorite charity or nonprofit to whom you currently give? Again, kind of the first thing is, are you charitably minded to begin with? If you're not, and you have no plans to be, then you may want to jump off of this webinar, because really just applies to folks who that's kind of their thing, right? That's just on their heart, that they like to give, and they like to give to charities and nonprofits. If you're giving to a charity or a nonprofit, of course, that would be a actual legal entity, right? A 501c3 organization that would actually give you a receipt, right? They would have record of what you're giving them. And so it could be some tax benefits associated with that, but also some record keeping that you want to make sure that you are keeping track of. Number two, do you understand the tax implications of various giving vehicles? So there are many. We're going to talk about some of the main ones today, certainly that could help you and could end up with not only more money in your pocket, but more money in the charity's pocket. And then, do you want a simpler, more streamlined means of giving for the long term? And, some of what we're going to come up with today is talking about not only the vehicles, but talking about a specific product or account that's set up through Fidelity Charitable. And I'll tell you that this is not a Fidelity commercial, by the way. I don't work for them. I'm an independent advisor, so I get no financial benefit either way. But it is an account and a relationship that we've been able to form strategically that has helped out a lot of our clients. Very easy to use. It's an example of one that's worked well for folks. So we're going to use that as our example. And then obviously you can open up your account or do what you want with any financial institution that would offer something similar. So we are going to talk about that just so you can see how does this actually work from a practical standpoint. And of course, a lot of our clients already have a relationship with Fidelity, so it may be easy or easier really to set it up with them, especially if you're donating things like securities or stock. So, talking about the benefits of giving strategically, we'll talk about the charitable landscape, popular assets to give. Again, you could just give cash. That's a very simple thing to do. But oftentimes, there are other types of assets that you can give to the charity, and they don't care. If you give them stock, they don't care. They're just going to cash it out, and they'll get the cash anyway. So there are some benefits to that on both sides. And then again, planning ahead, really thinking about not only how much you're giving, but when you're giving. That can make a big difference as far as taxes and also what the All right. Sorry, folks, you couldn't hear me for a second there. Technical difficulties. So hopefully you can hear me now. So looking at the charitable landscape, this is looking back to 2018. Of course, we'll get 2019 numbers coming up. But the one thing in the U.S., at least, is that we're a fairly giving country. I know people from other countries. In fact, I was just at a conference here a couple of weeks ago and was talking with a lady from Austria, and she said, yeah, in Austria, they are not very charitable. That's not something that they do. It's not a very common thing that people give money away because their tax rates are so high. And she said the reason why a lot of people don't give is because the tax rates are so high and they're actually required to give to like the church. Part of their tax dollars goes to support the church. So for a lot of people, they say it's already taken care of. I'm not giving any more money. In this country, we're blessed right now and that our tax rates are historically at least low right now. Not that, again, somebody would make contributions just because of taxes, but we have seen these numbers go up quite a bit. Now you can see, obviously, the Great Recession back in 2008, 2009, really charitable contributions dipped quite a bit, understandably, right? Because a lot of people do give based off of their income or maybe equity awards or stocks that are going up in value. So we saw a dip there in the financial crisis, but certainly things have taken off since then. And most of it's given by individuals. So there are foundations, of course, there's big corporate donations, things like that. But for the most part, charitable contributions in the US just come from us as individuals, either giving cash or giving securities or some other property. So let's talk about stuff. Again, cash is very easy to give. You probably don't need a charitable fund or anything fancy to be able to do that, right? You're just giving cash or writing a check or making a credit card donation. There's all kinds of ways, of course. Any organization of any size is going to have multiple ways that you're able to give them cash. So it's one thing to think about is that cash may be easy, but it may not always be the best thing, because if you have appreciated securities, those appreciated securities, not only are you going to make a contribution, they'll sell it and convert it to cash, but now you're actually able to eliminate your capital gains tax, because when you're donating appreciated securities, what's happening is you're getting the value as a tax deduction. You'll get a deduction for whatever the market value is of what you're giving on the day that it was given. So for example, if you gave shares of stock, you would actually be able to take the price that day that you gave the stock, that it was donated, and write that off as the value that was donated. But the reality is you may have bought that stock at a very, very cheap price. Well, it doesn't really matter, right? Because the charity doesn't pay taxes because of what they are. They're a 501c3, they don't pay any taxes. And then on your end, you don't need to know the basis. You don't need to know what you paid for it. So it's funny, in some cases, what will have happen is that people will actually end up giving old stock. Like for us, we've got a lot of clients that worked at HP. And of course, the company is split into umpteen different ways right now. And if you owned HP stock, you've got umpteen different companies in your brokerage account. Well, sometimes people say, I have no idea what I actually paid for this stuff when I started with the company decades ago. And some of these little stocks that people don't want to mess with, it's an easy way to get rid of them, right? Just donate them to charity, and then you don't have to figure out the cost basis because the IRS doesn't care. They just want to know the market value of the securities on the date that you donated them. So potentially that could allow you to give more by donating directly to the charity as opposed to cashing it out, paying the taxes, and then giving them what's left. So thinking about that, let's use an example. Now, this is a case where somebody's in the highest tax bracket, which as of right now is 37%. And hopefully all of you aren't in the highest tax bracket, or maybe hopefully you are. Actually, that's a really good problem to have. But 37% is pretty darn cheap when we look at historical tax rates. You can go back into the 70s and earlier, and you'll find some decades where the top tax rate was up in the 70-80% range. So we're pretty darn cheap right now. Nonetheless, though, if there's a strategy where you're trying to minimize the taxes on that, you could actually benefit by donating securities directly versus cash. So let's just use the example here. Let's say that you own appreciated securities valued at 50K, and you've got long-term unrealized gains of $30,000. That's great. It means your stock went up a value quite a bit. Now, because you're in the highest tax bracket, the marginal tax bracket, you're also in the highest capital gains tax bracket, which would be 20%, and then you would also get the benefit of paying the 3.8% Medicare surtax that would apply to those investment proceeds. So you end up losing some money. Certainly, you end up losing some dollars out of it. And so the charitable donation, instead of having the full 50K, now you've only got 42,860, and you only get a deduction of 15,858 upon putting it in. Well, what if we had given those securities directly to the charity? Well, that would have been a nice tax deduction because we not only do we not have to worry about the capital gains taxes, but now we've got a full 50K that the charity ended up receiving, and you get a bigger income tax deduction when it went in because you got the entire amount to donate. So keep that in mind that this is just one example. You could use the same example with something like property, right? What if you had an empty lot that was highly appreciated? You had some land, you had a house, maybe you've got a collector, Corvette from a gazillion years ago that has gone up in value somehow, and now you're looking at some big tax that you'd have to pay upon selling it. These could be ways that you would donate it directly to the charity. Charity gets 100% of the value. You get 100% of the value as far as taking the deduction, and nobody ever had to worry about those pesky capital gains taxes. And meanwhile, that 50K that you had in cash, now you still have that in cash, right? Instead of having to part with that out of your bank account or out of some other investment, you get to keep that and use it for something different. So hopefully that makes sense. Now there are deduction limits. So the deduction limits on cash to public charities is 60%. The public charity, by the way, would just be a 501c3, could be a church, could be United Way, could be Compassion International, any kind of name brand charity that's a 501c3 organization is going to be considered that. Then appreciated securities has a 30% limit, but you are allowed to carry forward up to 5 years. So keep that in mind. A donor advised fund is included as a public charity, by the way, which we'll get into later. And that's really kind of the crux of how a lot of people could end up benefiting from this, is that they'd be able to use a donor advised fund as a way to be giving the money away over time. So capital gains tax, again, potentially would just be eliminated by this. Now, short-term capital gains are even worse because those would be taxed at your ordinary income tax rate, which right now is a maximum of 37%. But long-term gains, and that would be anything that's held longer than a year. That's very important, and they're very exact about this, that they, I mean the IRS, and that you have to hold securities for greater than 365 days to qualify for long-term capital gains treatment. So right now, most people pay at 15%. Some people pay 0, by the way. If you're in the first couple of tax brackets, you actually wouldn't have any capital gains tax. For our clients, at least, most people aren't in that situation. They're in a higher tax bracket. But a lot of our clients aren't in the highest tax bracket either. So we do have some folks paying at that 20% rate. And again, for a lot of those folks as well, they get that 3.8% Medicare surtax thrown into the mix as well. So keep that in mind. The higher tax bracket you're in, the bigger financial benefit to doing this, right? So one of the things that you might think about is if you're still working or somebody is still working, would there be a bigger benefit to them making a charitable donation when their income is high or when their income is low? Well, it's when their income is high, right? So your highest earning years, which more than likely are at the end of your career, that could end up being a really good time to donate some securities or some other highly appreciated assets, because you would get a much bigger tax benefit than, say, if you waited the year after you retired and your income has gone way down. Well, dollar-wise, you didn't save nearly as much as you would have if you had donated stuff when your taxes were really, really high. So be thinking about that there could be some benefits to doing it earlier rather than later. Now, on the back end of things, currently at least, the rule is that from an estate tax standpoint, people worry about that sometimes, is really what's the impact to my heirs someday when I pass away and I leave stuff. So currently, not a lot of people have to worry about this. And if you're worried about this, it's a great problem to have, because it means that you've got a lot of wealth accumulated. But currently, we all get what I would just call a coupon. We all get a coupon of $11.4 million during our lifetime or at our death that we're able to pass on to human beneficiaries, and then nobody ends up paying any estate tax as long as it's less than that amount. So let's think about this for a second. Any type of estate, and it doesn't matter what the stuff is in your estate, they call that the gross estate, by the way, would be all your stuff that's in your name, your house, your property, your stocks, your retirement funds, your Roth IRAs, anything you've got would apply to that $11.4 million. Now, there's a concept called a unified credit, and the unified credit means that that $11.4 million can either be used one of two ways or both ways, right? So you could give up to $11.4 million away during your lifetime to human beneficiaries. And I say human as opposed to giving it to a charity, right? So there's a difference. So $11.4 million, so that could either be given as gifts over the years, or it could be all left at the end. But if you had an estate less than that, when it comes time to file the estate tax return, as long as you had left less than that amount or given that amount, the combination between those two things, then you wouldn't end up paying any estate taxes. So the highest current estate tax rate is 40%, by the way, which you say, well, that's not the end of the world. But keep in mind that with a lot of our clients, at least, they have a lot of 401k dollars or pre-tax dollars. And unfortunately, the income tax has to be paid as well, right, on those dollars. They haven't been taxed before. So if you had some pre-tax funds, your estate may end up paying not only the income tax on those, but also the estate tax. It could be quite high. In other words, the amount that you actually end up losing if your estate is north of $11.4 million. Now, of course, if you're married, you get double that, right? You have to have almost a $23 million estate. Again, that's a great problem if you've got that. And we should talk if we haven't talked already. So there's an unlimited deduction for charitable contributions, by the way, from an estate standpoint. You can give as much money as you want to away. You probably have heard of the Billionaires Pledge that Buffett and Bill Gates and a lot of others that are billionaires have pledged that they're going to give away substantially all of their assets during their lifetime or at their death to charitable purposes. So in their case, even though they've got billions of dollars, they can give as many billions as they want to away, and it's completely exempt from estate tax. So let's think about the different vehicles now as far as how do we make this happen. So there's donor-advised funds, private foundations, charitable remainder trusts, charitable lead trusts, giving strategies. So let's think about this. And of course, I'm going to kind of circle back to the donor-advised fund because it works for a lot of people, especially because it's pretty cost-effective and we can start with fairly low dollar amounts. But we'll get into that in just a second. So also thinking about, do you want to give while you're still living, or do you want to give and generate income? There are a couple of types of trusts that you can use. We don't see these used as often now They used to be used as more of an estate planning vehicle, but there are charitable remainder trusts and charitable lead trusts that actually would generate income and then would also benefit a charity while you're living or when you pass away. So we're going to focus on those as well as donor advised funds and then private foundations. So donor advised funds, let's talk about that first actually, because that's going to be, I think, what the majority of our audience today would benefit from, other than just outright giving to charities. So what is it? It's actually a charity in and of itself. So it's actually a program that's sponsored by a 501c3. Again, we're using Fidelity as our example. There's a Fidelity Charitable Giving Fund that in and of itself actually is a 501c3. So that means that anything that you donate to the charitable giving fund allows you to make it that contribution, and it is irrevocable. Even though you have some control over how it's distributed over time, it is irrevocable, so you can't get the money back out. And you may be eligible to get that immediate tax deduction. In other words, the year that you put it in, you get a tax write-off. Even in the case, how does it work? Well, you make the contribution either all at once or over the years, but you get to decide because you are the sponsor, right? So you get to be the individual that actually makes those elections each year, or not at all, how that money is given out. So you might pick any number of charities that you give to over the years, and you can give it out as you want. It could all be given at once. It could be given out over the rest of your life. You could skip years, so you don't make any actual donations or grants to those charities. So the donation itself is tax deductible at the beginning, meaning that you get the one-time deduction, and then over time, you are the one who controls how that money is divvied out to these different charities. So be thinking about that, because there are some benefits, and we'll talk about this in a bit, but there are some definite benefits to doing some bunching, right? Where we make a big contribution all at once, especially if it's in a really high tax bracket year for you. And in some cases, people are saying, this is going to be, I'm going to make this big donation, take this big deduction all at once, and then this thing is going to fund my charitable giving for years and years and years, where I normally would have come out of my cash flow. So think about that. You get to choose the charities inside of there, and you get to choose how you give the money and when you give the money. So really, who's a good candidate for that? They want something easy. First of all, they want something that doesn't cost a lot. They want the tax-free growth. So when the money goes in, that's a common question is, well, where does it go once it goes in there? So if you're donating cash, then it just gets invested. You have some control over how it gets invested inside there. So there are some choices. But also, if you donate anything else, let's say it's property, stock, you can expect that will get sold immediately once it goes in, because they really want to diversify that out and not have all that risk in that one security. So the sponsor, Fidelity in this case, would not be in the business of wanting to watch your stock. In other words, it's just going to get liquidated. And of course, because it's a charity, there's no capital gains. So also, it's somebody who wants a lot of flexibility. They want the flexibility to give as they want, to who they want, and when they want. They don't want to have a lot of shackles as far as how they're giving over the years. So it kind of acts like a foundation. Now, a private foundation, it's pretty expensive. It's pretty complicated, and it's one of those things that if you're a big celebrity or something like that, obviously you may end up with a big foundation that's set up that they manage. They may have their family help manage it after they passed away. It's kind of a cool concept, but the cost and the complexity involved in managing that organization really, for a lot of people, doesn't make sense. Think of it as something for the ultra wealthy that would make sense to actually be hiring staff and having, excuse me, a whole bureaucratic structure around it. It's not simple, in other words. But for a lot of people, the donor advised fund kind of does the same thing with a lot less complexity and a lot lower minimums and cost. And the charitable remainder trust, what this really involves is it is an irrevocable trust. So it basically involves an income stream. When you're putting money in, either for you or your beneficiaries, you end up getting income out of it, and then the remainder ends up getting left to charity later on. So it's somebody who wants the immediate deduction, so you do get to take that as well, but one income. Versus a donor advised fund is more for somebody who says, nope, what I'm putting in, that's kind of a permanent gift to the charities. So it could be a good use for some people, And then, charitable lead trust does a similar thing. You want the immediate deduction while being able to have some control about how it's distributed back to either you or to your beneficiaries. So again, we don't see that happen as much, but if you're thinking, hey, that's appealing, I'd like some income, think about that. So, as far as the advantages of doing this during your life, you have to kind of think about, do we do this now or do we do it later? We talked about this a little bit last month when we visited about how do we make gifts really to individuals when we're living or when we pass away, and really when do we want them to receive those funds? And one of the big advantages, of course, of making gifts to people while you're living is that you can have some influence, certainly, and that you can make some decisions or help them make good decisions with the money and help guide them so they don't do stupid things with it, you hope at least, versus somebody passing away and dumping a big lump sum on somebody. That doesn't always go well. In fact, it rarely goes well when somebody receives sudden wealth. Think lottery, think NFL players, things like that, right? It just doesn't tend to go well, and the money goes away pretty quickly. So, the impact of that can be good as well because people can enjoy it being used, right? They can see the impact of it. And that's the other part of it, right? Is for a charity, is you get to see the charities receive it, right? You get to see them benefit from it now. You get the satisfaction, at least personally, that they're receiving those donations and you were the one who made the election on any given time frame, right? Over the years or all at once. So, think about that. So, excuse me. Retirement assets are not ideal. I will tell you that for a donor advised fund, you can't do retirement assets. You can't donate retirement assets directly, except for one exception, and that you are eligible to do a qualified charitable contribution if you've reached required minimum distribution age. Now we're going to get into the weeds a bit here for a second, but one thing that does apply, and the tax code is going to change here pretty quickly if the Secure Act passes, but the one thing to keep in mind is that you can make a qualified gift to charity as long as it's a direct qualified gift to charity from your required minimum distribution from your IRA or 401k. You can do that up to $100,000. So one thing that changes a little bit with this new bill is that you'll find that, number one, the age has increased or will increase from age 70 and a half now to age 72. And so that's the new beginning date, the new year that you'll have to start taking required distributions. So what that tells you, though, is that if you're 70 right now and you turn 71 in 2020, if this thing passes and gets signed into law, that's something that you were probably anticipating that, hey, I'm going to have to take an RMD next year. Well, now you won't. Now that's not something that will apply, meaning that you'd actually, in this case, if you were thinking about taking part of that RMD and giving it to charity, you have to wait until that following year because it has to be a year that you would be required to take the distributions. So keep that in mind, that does apply. The other thing that really applies in a big way is that they've eliminated the stretch distributions on retirement assets as part of this bill, meaning that any humans that would be receiving your assets, the pre-tax assets like 401ks and traditional IRAs, they used to be able to spread out distributions over their entire lifetime when they receive distributions as a beneficiary. Now that's gotten accelerated, so they'll have to distribute it out completely within 10 years of the owner's death. So that's a big game changer, especially for people who have large IRAs or large 401ks. That is like a huge tax increase basically on beneficiaries. So keep that in mind. Sometimes people will make some shifts like do Roth conversions, or they'll start maybe making their donations from their retirement funds and keeping their after-tax funds. So certainly a lot open for discussion there. So, and again, the unknown basis thing, we talked about that sometimes people receive stock as an inheritance and then they have no idea what so-and-so paid for it, or they received it as a gift, or they just received it as a spin-off from some other company. So that's kind of handy that you can just take stuff that you have no idea what you actually paid for it and donate that. Doesn't make a difference. And then, certainly you can shift strategy as time goes on. One of the benefits of leaving things when you die is that for any non-retirement assets, you will receive, or your heirs will receive, I guess, the current rule is they get a step up in cost basis. So what that means is that, let's say that you had some highly appreciated Apple stock. We'll just use that as an example. And let's say that you bought it in the early 90s when it was really cheap. Well, now that that's worth $1 gazillion, it's highly appreciated. So, it's something you actually could hold on to that Apple stock. And when you die, your heirs actually receive a step up in basis. You could also take that Apple stock and donate it into your donor advised fund, right? So that would be something else you could do with it right now. What it wouldn't be a very good idea would be to gift that stock to somebody, because now you've just gifted not only the stock, but you've gifted the basis as well. And now there's a lot of capital gains limit that, or capital gains dollars that'll have to be taxed. You'll end up losing some money. So again, that's kind of back to the thinking strategically thing. Excuse me. Thinking strategically about this, we want to make sure that we use the rules to our advantage, right? It's important that we understand how this all works, because we could leave a lot of money on the table, not even for just ourselves, but for beneficiaries and also for any charities that would be receiving the benefits. Excuse me. Roth IRAs are also tax-free to beneficiaries as well, so that would probably not be the best thing to leave to a charity, because they get stuff tax-free anyway. So now, this is interesting, right? We have to kind of think about what are the different types of assets I've got. What are the best things to gift to people at death currently? What are the best things to give to charities at death or currently? And think about really where we're going to end up with the most dollars on an after-tax basis, depending on how we're giving, either currently or at death. So it's really important to think about your estate planning when it comes to this, because your estate documents, your beneficiary designations, your giving strategy, that's all very tied together. And we want to make sure that we're doing this consciously, right? We're making those decisions consciously and not looking back later and having to say, oh, I wish I would have known that, and having paid a lot more taxes or maybe a lot less money that could have been received by somebody else, including the charity. So, again, let's think about the taxes here, the tax scenarios. So bunching we talked about before. So there's, some strategies where people always give the same amount of money each year. So let's say we do that 1, 2, 3. Well, now there's some deduction limits, right? For a lot of people, they're not itemizing anymore, because their standard deduction of $24,400, everybody gets that now. If you're married, it's $24,400. So for a lot of people, there's no reason to itemize anymore. They just end up taking the standard deduction. So they're finding that, I'm just not able to deduct my charitable donations anymore. That kind of stinks. Well, what if we were to give it all at once? Let's say that we gave the big chunk of money, $30,000 all at once. We end up saving a bunch of money that year, especially if we're in a high tax bracket like our example uses, and we're able to give those funds to the charity. They still end up receiving the money. We can still give it to them over 3 years, but now we're actually in control of actually getting a larger deduction because we bunched it up and used it all in 1 year. Plus, the other benefit is that it alleviates your cash flow because you've kind of fronted the money up front. And of course, you could figure, hey, it's going to earn something, so I'm going to figure some time value of money stuff into it. You get fancy like that, but bottom line is it could end up alleviating some cash flow in those other years because you wouldn't be worried about money coming out of your pocket to make those charitable contributions. So bottom line, just by bunching the contributions in this example, giving all the securities or even cash all in year one, ended up with $6,500 more to use for something else. Maybe you even give that extra money to the charity. Great. But at least it goes to somebody instead of everybody's least favorite charity, which is the government. So, thinking about tax-free donation growth, when it comes to the donor advised fund, we talked about the fact that when it goes in, you actually do have some control over how it gets invested. So you actually do have some pieces in there that you're able to, as the grantor, you're able to still exercise some control. So sometimes people kind of worry and they say, well, one or two ways, right? I'm going to donate some stock into this thing. It's going to get sold. Well, some people would say, well, I don't want it just to sit there. I'm going to give it over the years, so I want it to grow, right? So there are different investment options that would allow you to basically put the money in, invest it in stocks, mutual fund type investments, or you could invest it in bond type investments or some mixture between those things. And asset allocation simply means that it's probably something that has a little bit of everything. It's probably going to be very diversified based off of your comfort level. Some other people worry about the opposite, though. They say, hey, I'm going to put this money in. I want to make sure that the market doesn't tank after I make the investment, because I want the charity to get all the money, right? I want to make sure that the likelihood is going to be here that this thing doesn't just tank and lose half of its value. Because of course you get the state tax deduction, the federal tax deduction when it goes in at the beginning, but that would not feel good, I think, to most of us, to have that go way down and not have as much money to actually benefit the charitable organizations that we were thinking about before. So for some people, they may end up having some type of a balanced strategy where it has some stocks and some bonds. For some people, they may become 100% stocks, 100% bonds, 100% money market. We've got all those options essentially that we can think about. And there's also, for those of you who, it's something that's in part of your investment strategy that you want to have an impact on how you invest. There are some sustainable impact funds that are available that does some filtering for social purposes. So keep that in mind. Again, this is not a Fidelity commercial. It's just kind of giving you an idea of how this works and kind of the order of things, that you give securities or cash, it goes in, it gets converted then into whatever you've selected then as the donor as far as your investment strategy. And of course, we can certainly help with that as far as helping you guide you into the right investment options for you with really what your objectives are. What is it that you want those dollars to do over time, and how much risk are you comfortable with? So the grant recommendations, sometimes people wonder about this. Okay, so I put money into this thing. How much control do I have? How do I actually see my account? So it's pretty easy. You basically can recommend grants, and that's how it's termed, is that you're recommending grants from a practical standpoint. As long as it's a qualified charity, that's who it's going to go to, right? So basically, you've got a lot of ways that you can make those, including an iPhone app. There is an app for this now that you can get into your account, maybe just on the fly. Maybe you just have a small donation you want to make to an organization. If your money is already in the Donor-Advised Fund, you can do that right from your app. So there's due diligence, again, that they have to make sure that it's a legit charitable organization, right? Because you can just imagine people could use this to their advantage and really, do some bad things with it, right? Where they're actually ending up sending the money back to themselves or their kid or something like that. So they do some due diligence. Believe me, you want them to, because you don't want, first of all, you don't want these things to get shut down where it's not even an option anymore. And if there was corruption going on, of course, that would happen eventually. But also you want to make sure that it's legit, that when you get audited someday, and you want to make sure that you don't get your qualified donation get nixed, right? It's possible that could happen, where the IRS would disqualify your charitable contribution and make you go back and pay taxes if this was not a legitimate vehicle. So believe me, you do want them to be keeping this thing compliant with regulations. So, but it's specific. I mean, you can be very specific about dollar amounts, about what organizations, and you can change those over time, by the way. It's not just a one-time election where you have to choose a charity and then, for all history, that's the only charity that can ever get the money out of it. So you are eligible to change those over time. You may support a certain organization, maybe it's Toys for Tots right now, and then in a few years you decide, no, I've given as much as I feel called to give to them, and I want to give money to the church, or I want to give money to the United Way, or whatever that is for you. So you are, certainly it's a situation where you've got flexibility. And then, again, it could be just on your behalf. Obviously, the charity would find out that the donation was made from Josh Nelson, but you can also put it into somebody else's name. Say maybe it could be, you put it in one of your parents' names. It could in your mind act kind of like a grant, right? Where it's maybe a parent who passed away and you want to give to an organization that they supported and have them see that it was given by them or in their name on their behalf. But also you could do it anonymously. Certainly for some people, they say, I don't need acknowledgement. I don't need anybody to see where the money came from. You can do that anonymously as well. So completely up to you how you actually set that up. The whole point of this is it's pretty darn flexible, as far as how you would do this. You also can change the amounts each year. You can sometimes give no grants, in other words. So you might give some larger donations some years, less in other years. Remember, you got the tax benefit up front, and once the donation's made up front, you never get another benefit on those dollars again, by the way, unless you give more money into your fund. So keep that in mind. The growth is tax-free, though. That's certainly nice. And so you could think of it that way, that there's a tax benefit simply because you don't have to pay any tax on the growth, on the dividends, whatever it is that's happening inside of there. And then a few tools, you may want to screenshot this with your phone or something like that. If you're using Fidelity, GuideStar is actually free, by the way. So you have the premium subscription, which lets you do all kinds of due diligence. Sometimes people are wondering this, and I've wondered this too, right? When you give to a charitable organization, how do you know they're legit, first of all? But the second thing is that there's all kinds of ratings that are out there that will kind of rate charities based off of how much overhead that they've got. In other words, how many of the dollars that you're giving, how much of each dollar that you're giving is actually going on to that organization that you want to benefit. So it's important to look at, certainly. There's a few resources here, but again, GuideStar would give you the premium, which gives you a lot more details. That way you can make sure that whoever you're giving to is really the people that you intended the money for are actually getting it. And so that's your own due diligence that you're able to do. And so it gives you some flexibility, certainly, to make sure that that those dollars are going where you intended. So bottom line here is that the better you understand any of this stuff when it comes to financial planning, to any of your money, bottom line is it's really important to understand the rules. And I think that's why people like me have jobs. I'll pop on my camera here again. At the end of the day, I think that's why we still have jobs and always will, because the rules are complicated and the rules always change, right? So for the Secure Act, the thing we were just talking about, that's huge. And for those of you who don't maybe even know what that is, keep in mind we'll be doing webinars on that topic and looking into it. Big changes. The 2017 Tax Act that just passed here a couple of years ago, that made huge changes. So the rules of the game change all the time, and of course your life changes. Really, that's why financial planning exists as a profession, because people don't want to become financial experts. They want to trust somebody else to be able to help guide them through really this jungle of the financial world that not only is complicated in its own right, but because things are changing constantly, it's really hard to be able to keep up with all of them. So keep that in mind. At the end of the day, we want you to feel confident. We want you to feel confident in your financial plan, in your not only your own financial security, but also in really the plans you've got for your money over time with regard to your legacy, really who's going to benefit from that. And that really was what last month's webinar, which is on our YouTube channel, by the way. Feel free to go out there and click on that. If you go to keystonefinancial.com, by the way, we've got all of our webinars that we've done in the past are there, and you can go back and look at the gifting one. This is the gifting to individuals one last month. This is the gifting to charities this month. So think about that, certainly, and use those as resources, not only for yourself, but also please help us get the word out there that, hey, these resources are here, whether people do business with us or not. That's really our mission, is to make people's lives better. We want to improve people's lives and help people feel confident and secure in their financial decisions. So with that in mind, I'm going to open it up for questions. Certainly let me know if you've got questions that haven't been answered. Jeremy may have been typing away there, which is great, but I wanted to just throw it out to you that I'm here as well, here for a couple of minutes to be able to answer any questions that you've got. So we'll wait just a second here and see what we've got here for questions in the queue. Mr. Bush, do we have anything?
You know what, we had a couple from Ryan. They're pretty specific to his position.
Okay.
So.
Yeah, that's great. Of course, any questions you ask that are personal questions, we won't answer unless you want us to. We don't want to reveal people's financial situations. That's why you pay us, right, as clients, certainly. But any kind of global questions that would benefit everybody. One thing that a lot of people ask us for is, do you have any book recommendations? So we gave you those resources before that really gave you a couple of items as far as the logistics behind researching charitable organizations. But a couple of things that kind of popped into my mind as far as books that I've really enjoyed. One of those is Give and Take by Adam Grant. Some of you have probably already read this, but it's really more philosophically about giving and taking, and how we're kind of wired, at least American society is kind of wired more to the taking side of things, when in reality, I think for those of you, especially who've been around for a while, I think that that true fulfillment actually comes from giving. It actually comes from contributing to others and in helping others. And oftentimes, even in the business world, oftentimes by contributing and giving, you actually end up getting a lot more back than what you may have thought. So kind of interesting on that one. The other one too, especially for people who are starting out, I always want people to have resources there. I don't know if you can see this, Total Money Makeover by Dave Ramsey. I actually just read this a couple months ago. It's not a new book, but I had never gotten a chance to read it myself. But he talks about a lot of steps from kind of square one for people financially, as far as getting to a point where they have gotten financially secure. As you can imagine, some of the stuff in the early baby steps in there is about setting up a cash reserve and then coming up with a real plan to get debt eliminated. That's an epidemic right now. Even though the economy is good, people have very high debt levels. So he talks a lot about that. But of course, once people are financially stable and they've got their investment portfolio built up, now it comes to, well, how do we enjoy it? How do we give it, right? And so he talks about that in there as well. And then finally, by Jamie Hopkins, actually our director of retirement research, Jamie Hopkins, he wrote a book called Rewirement, and he does talk a lot in there about tax strategies and about the different categories of accounts. So the stuff I was mentioning before, as far as Roth IRAs, traditional IRAs, 401ks, the best things to give and donate to leave, he talks a lot about that in there, and about some strategies, not only for retirement income, but about giving as well, and how we're benefiting others and certainly charitable organizations. So a little bit of discussion, certainly from Jamie over the years as well, about charitable contributions out of retirement funds. Very important, by the way, all the stuff we're talking about, very important that you talk to a tax professional before you make any big changes. We've got resources for you we can refer you to as well, but very important to look at your individual situation. We were just doing kind of a general flyover here, right? But very important because everybody's financial situation is a little bit different. Everybody comes into the financial plan with a different collection of kind of financial stuff and income and certainly family background as well. So it's very important that financial planning be done as on an individual basis. So see if we have any other questions that have come in.
Actually, Brian has a good one.
Right.
Is there interest earned on the remaining sum of donor-directed funds?
Good question. So if I got this one right, I'll repeat it. Is there interest earned on any remaining charitable funds? And the answer is yes. So you'll have earnings on those funds that sit in there, and you're able to direct that as far as how much risk is associated with it. The other question, I'm glad you brought that up too, is the word remainder. Well, what happens when I die, right? What happens when I'm not around to be able to direct those grants? Who actually gets the money? So that's why you're designating, and you kind of have some default designations that you've made inside there, that the charitable organizations that you have named as of your death will automatically get the remainder of the proceeds. So that's important to remember that's there, that is there kind of as a backstop in the end. That's where some people kind of think about private foundations and say, well, maybe I should let my kids manage it, that sort of thing. So you can kind of work with them. In some cases, people will actually help their kids make contributions to donor-advised funds as a way to start teaching them about giving and to have your guidance right along the way. So thinking about that. But yes, there are earnings. Of course, anything you invest in isn't guaranteed, right? So it could go down in value. So you want to be a little bit careful about that, because certainly investing in stocks in the short term, at least, is very uncertain. And there are a lot of years where you could be way down in value. So think about that. Think about really what your real time frame is for the money and what your expectations are from year to year. Of course, that could depend very differently. Some people might consider it a very long-term investment, and so they put it all in growth investments and stock investments. Other people might be thinking of it that they don't really care what they earn. They might just want to earn a little bit of interest and have it in a money market type option. So keep in mind, you've got a lot of flexibility over that, and you can change it over time. It's not just a one-time election.
John also has another question asking if your children can continue the donor-advised fund.
Good question. I'm not sure on that. You stumped me. We'll find out, though. Certainly, can children continue it on, unless Jeremy knows?
Off the top of my head, from what I've noticed, it gets set up in your name specifically. And so I do not think that that is something that can pass on. You can set up the timing of the charities. And so if you wanted to go for 20 years and you pass away 10 years before that 20 years is up, you'll still continue to do so. But I do believe it is tied to each individual person.
I think you're correct on that. So you can't pass it down to generations, But he brought up a good point that you can set up some automated contributions if you just know that you want to give a certain dollar amount every year as far as a grant to a certain organization or multiple organizations. You can set that up, and that would survive your death. So there is some flexibility there as well. What other questions? Anything else that we've got in the queue?
I think that is everything that's gone.
All right, great questions. And again, I know a lot of people are going to be watching this after the fact. They won't be watching it live. So certainly any questions that you've got, let us know. You can see our web address on the screen right now at keystonefinancial.com. Our email addresses are just josh@keystonefinancial.com, jeremy@keystonefinancial.com. So certainly reach out to us. We make ourselves very available, I think, to people on a day-to-day basis, because we want to make sure that people are making good decisions and informed decisions more than anything, that people aren't just unconsciously going through their financial life, which I can tell you most people do. The vast majority of people in America, at least, are very unconscious when it comes to their financial decisions. And so they end up with a very wide variety of results. Sometimes people end up still being very successful just by accident, but a lot of people, I think the majority of people, end up being really disappointed at where they end up financially, not because they intended to fail, right? But just because they went through life without a plan. They didn't have any guidance, and they didn't invest the time themselves. Of course, that's really why, again, we've got jobs as financial planners, because the reality is most people, they don't have the time, first of all, right? Everybody's so busy that they don't have time to be able to watch their money and research all this stuff, right, as far as how things are changing. But also, there's the technical side of things, but then there's also, really, is it something that you want to do, or would you rather spend the rest of your time, the free time that you've got, not being a financial expert, but going out and hiking or four-wheeling or whatever it is that you do? For a lot of people, they see that as a good trade-off of time, because they're letting us worry about that stuff. And then finally, emotionally, right? We all can get wrapped up. Sometimes people think, oh, well, finances, that's not emotional. Yes, it is. Even corporations, I think, can make some emotional decisions at the highest levels. So certainly us as individuals can be swayed by our own emotions, and certainly by the media. The media will oftentimes lead you astray because they're there to scare you, and oftentimes will lead you to do stuff that you wouldn't have normally done. Especially when it comes to investments, you may end up cashing out when things are going down, or buying in when things are really expensive, simply because the media hype tends to push people in that direction. So it's really important to think about that, as far as, are you somebody who wants to self-direct, or really do you want somebody who's an experienced guide to help you through this? So with that in mind, I'm going to wrap it up here. I think we're a few minutes early. We want to always wrap these up within an hour, because we want to respect your time. Time is the one thing you can never get back, right? And I can't either. So want to make sure that we're concise, but we get you the information that you need to make good decisions. And certainly let us know how we can help, either for you or for somebody that you care about. We always want to be a resource. And a lot of times, even if it's just a quick question, we're not going to charge them for that, right? If somebody calls us and they just need to be pointed in the right direction, we'd much rather have a 5-minute conversation than have somebody make some crazy decision that really ends up hurting them. And it's something that could have been remedied pretty quickly. But for those of you who really want more of a long-term relationship, certainly we can talk about what does that look like to become a client, and really what do we do for clients? What does that relationship look like? Always open to having that conversation with you. So with that in mind, I'm going to wrap it up for today. Have a very Merry Christmas. It's Christmas time right now anyway that we're recording this. So depending on when you're listening to this, happy Merry Christmas, or whatever holiday we're close to when you listen to the webinar, but also Happy New Year. And I hope you have a very, very prosperous 2020. Thank you. Take care.